Everyone, I want to go over the market eternals. This is something I feel like many people don't know about or they overlook in their trading. So let's go to it. First, let's just go ahead, pull up a blank chart here of the S&P 500. We can look at the SPY and we'll look at it on a 5-minute chart. We'll look at today from the opening bell. Just a blank chart, nothing fancy here. And then we'll look at the first market eternal, which I feel like is the most important, is the NYSE tick. I like using it personally at a 15-minute chart, but we'll look at it at a 5-minute just for the sake of this video. And if you're wondering what is the ticker for it, it is $TICK. On most broker platforms like Thinkorswim, S&P, you can look at the SPY, SPX, or of course the E-mini S&P future. So what the tick is measuring is the NYSE tick of stocks upticking versus stocks downticking from their previous traded price. So out of all the stocks on the NYSE, it is going to show you. I personally like using the as a gauge the S&P, like I said, the SPY or E-mini S&P futures. But this is something I always keep up on my screens because the correlation is pretty much 1-to-1 with it. What does that mean? As you can see here, I have highlighted positive 800 indicates institutional buying. When you hold a positive 800 tick, it means the market is going to continue to usually move higher. Personally, on a short-term trading, like a day trading point of view, if I'm trading the E-mini S&P futures, on a positive 800 tick, if we get there or above, I'll use that as a profit to basically feed the ducks. Let's say I have 10 contracts on. If we get a positive 800 tick, I'll usually trim about half of those, because usually after a positive 800 tick, we go right back down. If I'm short and I want to look for a time to take profits on my shorts, I'm going to look at a negative 800 tick. Negative 800 indicates institutional selling. Anytime you get an extreme reading, positive 1,000 or positive 800 or positive 1,000 or negative 1,000, it means there's very, very aggressive institutional buying. For positive 1,000. Negative 1,000, very aggressive institutional selling. That's when you really get those quick, sharp declines in the market. Anything between 500 to negative 500 indicates chop. Chop, 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 to where the market is not going to move, or you're going to get in a choppy pattern. So you can see today, and let's look at it from the opening bell. We have the market opened pretty much flat here, and then the market took a dive, right? About nothing crazy, but took a dive. What happened to the ticks? They went lower. Nothing crazy, but about a negative 600 tick there in the NYSE tick. So again, nothing crazy, but it was a little bit of a down tick. Market went down a little bit. You can see market bounced. The ticks bounced to about positive 400. Again, nothing crazy. And now what has happened is we've basically been in a chop zone. Again, it's about 11 o'clock right now. The market has been pretty much a little grind higher, but again, this is only very, very minimal. And you can keep your eye on it as a gauge. You see we have a little red bar here, negative 100 tick. Nothing to get ticked off about, to say the least, but it does usually move in 1-to-1 correlation. If you do have the market moving up and the ticks are going down or not moving, that should give you a big red flag saying, what is going on? Something is wrong. So next thing we want to look in the market eternals. This is like looking under the hood of a car, right? You don't want to buy that Ferrari with a Honda motor or a Kia motor. You want to have that big V12. So you can see down ticks here. S&P very, very minimal, but you can get a glimpse of how it moves here. Is the NYSE the TRIN index? Now the TRIN is not perfect. You're not going to have a perfect correlation. This is something I usually like to look at in the morning and at the end of the day. And the TRIN, the only levels you're really going to need to keep an eye on is 2, and you can see we're not even close, and 0.6. 0.6 means we're at an extreme aggressive level, and the NYSE TRIN is the Richard Arms index. Basically, when we're down here at 0.6 or below, it cannot stay there. It has to go up. If the trend starts going up, it usually reverts around 0.8 to 1. That means the market will move inverse to it and go down. So if we look here at, let's go ahead and look at Friday. You can see we had about a negative 0.57 tick. And what happened to today in the markets? Well, we're up a little bit. Again, the trend cannot stay there. The trend went up. there, back to normal levels, and you can see the S&P, again, we call a little bounce here today. If we have a trend, let's say at 0.2, that is extreme, and we had it here on 8.5, it looks like. Let's see what the market did that day on 8.5. You can see we were at 0.2 on the trend, and this is when we had that massive sell-off day. The trend had to go down, right? It can't hold that 0.5. You could see it move lower, and what happened the next day in the market? Well, it rallied higher. So think of it, the trend as inverse correlation. Next thing we want to look at, and this is pretty much on a one-to-one level, is the ADD line, the advanced decline line. Stocks advancing versus stocks declining. I like using this on a 5-minute chart, and this again go pretty much one-to-one with the S&P. If it doesn't, we're going to look at big red flag. So again, this morning, S&P gapped open higher a little bit and then traded lower. What happened to most stocks? Again, this is all the NYSE stocks. They were declining. So even though we got a little bounce here in the market, not a lot of stocks on the ADD line bounced too, right? We're still in negative territory, and the market is going up a little bit here, and the ADD line, it really isn't moving. This is a big question mark for me because this tells me that most stocks are not advancing. In fact, most stocks are flat or declining from their previous traded price. So that can mean maybe it's a handful of stocks pushing the market higher. Maybe it's your stocks like Nvidia, your Apple, your Microsoft, your Google that are making up the market and basically putting lipsticks on a pig. And let's just go ahead and look real quick. Nvidia, there we go, up $5. Apple, look at that, up $3 on the highs. Meta, not really doing anything. Google, not much. Amazon, well, there we go. Let's just look at the semiconductors. There we go. So we can see it's only some of these big tech and semiconductor stocks that are making up the S&P, making it look pretty, when in reality, let's look at utilities. Well, they're down on the day. Energy, they're pretty much flat on the day. Industrials, they're down on the day. Let's look at consumer staples, they're down on the day. Let's look at retailers, they're down on the day. So you can see a lot of stocks and sectors are down on the day, but yet those chip stocks, some of those tech stocks are making the S&P look good. Now that's where that ADD line is really important, because it can let you know, hey, if those stocks that are holding up the market take a dive, well, then we're going to have a sharp, steep decline in the S&P, and it's going to follow suit of the ADD. So keep all three on your charts, but more importantly, look at the NYSE tick, look at the ADD line, especially if you're day trading. Most stocks that are correlated with the S&P, day trading options or the futures, and I'm out. And let me know in the comments what you think and make the next video on next.